Hey, what's up guys, welcome back to the channel. So in this video I want to do a quick update as to what's gone on in the market over the past few trading days, as we've had some significant volatility in some of the biggest companies in the world like Facebook, Snapchat, and obviously Amazon after they reported some pretty interesting earnings numbers. And generally speaking, the way that the market has reacted recently and the insane volatility that we've seen not only in the equities market, but also in the options market tells me that we could be in for a pretty significant small cap earnings season later this month. Because if you ask anybody who's been in the market for more than 5 to 10 years, you realize that they're all saying that right now we're seeing some of the highest volatility that we've ever seen in the stock market. And it's definitely pretty evident from seeing Facebook drop around 26% and wiping out around $232 billion in market value in a single trading day. And it's pretty unsurprising that Amazon went up around 17 to 20% in this very volatile market. But as for their actual numbers, it turns out Amazon is expected to grow around 3 to 8% in next quarter, which is similar to what Facebook announced when they reported their earnings of a growth of around 5 to 8%. And as we all know, big tech companies typically are expected to grow well into the 2 digits. So it's very surprising that these stocks have reacted so differently when both of these companies ended up reporting some very mediocre earnings. Now I'm definitely going to do a separate video on Meta and Facebook to analyze exactly why this could be a buying opportunity for that specific stock. But what we have seen in the market happen with Snapchat and Pinterest really goes to show that a lot of the small cap stocks that have been beaten down so aggressively over the past year are potentially getting ready for a big move if their earnings reports spark some interest from investors. Now, generally the big takeaway from this week's earnings is the fact that advertising is something that a lot of companies are cutting down aggressively on over the past couple of months because we're obviously seeing this very aggressive labor shortage. And the big reason why Snapchat and Facebook ended up actually reporting some pretty contrasting earnings because Snapchat is actually much earlier in their monetization stage for their app. And the CEO also said that Snapchat is built on a much more privacy protected stack, which means that Apple's stricter privacy terms ended up not affecting Snapchat that much in the long run. But it's safe to say that the future of social media is definitely more of a TikTok type platform instead of some of the very old stuff we see on Facebook these days, which is primarily reserved for some of the older people in our community. But obviously, as you all know, that was not the biggest news that came out this week. The biggest news by far was the January jobs report, which actually came out much better than expected. As you guys can see, non-farm payrolls, or basically the number of jobs that were added in January, were around 170% higher than the one that was expected at around 125,000. And the unemployment rate also ended up going up by a very small margin, but unfortunately, the average hourly wages also went up by actually a bigger margin. So essentially this report was very mixed, and that's probably the biggest reason why the stock market really didn't have that big of a reaction, although it did end up selling off in pre-market and then recovered pretty nicely at the end of the day. And the big reason for that is obviously because a good jobs report shows that the economy is very strong and that the Federal Reserve might have a little bit more reason to increase rates more aggressively because obviously inflation is going out of control. And obviously as wages increase, people have more money to spend, and as a result that can push inflation up even more. But a very bullish sentiment that did come out of this jobs report was the fact that the labor force participation rate actually went up by a very slight margin, which shows you that there are more people out in the workforce and potentially that could bring down wage increases. And that would definitely be one of the first signs we could see in an inflection point in inflation down the road. So you definitely want to keep that in check over the next few months as we see the jobs report come out. And obviously whether or not this is actually going to affect the Federal Reserve's decision to raise interest rates is something we're going to have to see with the CPI report that's going to come out on February 9th next week, and obviously the FOMC meeting that's also going to happen next month. But generally speaking, for me, I don't think that this report is a bearish signal for the market, and I don't think it's necessarily a bullish signal for the market. It only shows that the economy is strong and that Omicron might not have acted as big of a catalyst for inflation as we initially expected. Now, if we look into some of the major technical data for the market that's come out over the past week or so, we have a very good idea as to what investors are kind of expecting over the next month, because obviously in March, we're expected to see this very significant increase in interest rates from around 25 basis points to potentially even 50 basis points. And the reason why I'm personally a little bit bullish right now and I'm buying stocks instead of selling stocks is that the market has talked about inflation for a very long period of time. I mean, we've had interest rates on the media and inflation related data for such a long time, for almost 6 months or so, which means that investors have had a very long time to price in the effects of higher interest rates. And we're seeing that reflected through things like the VIX term structure. As you guys can see, this is essentially an indication of where VIX futures are for different options expiration dates over the next year. And as you guys can see, we're in a very, very normal market where people are not necessarily expecting higher volatility for the future. And it basically shows you that investors might not be as scared as a stock price action might show you. And on top of that, if you look at the McClellan oscillator, which is essentially an indicator that signals bullish to bearish pressures in the market, we are most definitely in a very bearish sentiment for the stock market. Essentially what this tells me is that a lot more people are raising cash and selling their stocks. And as you guys can see, that's not really reflected that much in the stock market. And so essentially what this could mean is that retail investors and people who are very short-term minded are selling stocks right now and putting them into the hands of institutional investors who've been supporting the market all this time. And as you guys can see, whenever this indicator has been in this very bearish territory, the stock market has generally signaled a very nice bullish trend for the next year or so. Obviously right now could be a little different because we have a lot more macroeconomic uncertainty, but generally speaking, this is one of those indicators that tells you right now you actually want to be a buyer of stocks instead of potentially sitting on cash. And as you guys can see, the call to put ratio has actually gone up as well, right back to those very highs that we saw in the middle of last month, which again tells me that because of the big tech drama that we've seen happen over the past week, a lot of people are flooding into put options, and potentially the market could reverse as institutional investors try to expire all these puts worthless. And obviously to expire a put option worthless, the stock market has to go up, and that is exactly why this indicator has performed as a very bullish buy the dip indicator for the past couple of years. As for the Russell 2000 small cap ETF, as you guys can see, it has bounced off very nicely from that line that I had drawn in last week. Now ideally what I would like to see is a pullback to that area and a confirmation of support before we end up rallying back to this $200 level. But as you guys can see on the 1 hour time frame, we have already formed this very nice double bottom. So if we break above this 204 level on this specific index, that could be a very good bullish confirmation for stocks in the short term. And as you guys can see, the RSI is still near that oversold territory, which means that the downside right now is much lower than the upside for the market. And even on the S&P 500 index, we ended up bouncing from that 50-week moving average very nicely over the past week. And with this insane volume that we've seen happen on that specific candle, we could be in for a near-term bottom. And it seems like the big tech earnings season has really not added that much volatility to the market. Instead, it just led to a lot more fighting between bulls and bears as seen to this insane amount of volume. But if you're a long-term investor or a swing trader who's looking to deploy their cash, I would look for buying opportunities around this 424 and this 405 level on the S&P 500 if we somehow get to those levels. And for the IWM, the same levels apply around that $190 support level and potentially all the way down to this $172 support level. But like I always say, make sure you guys are taking advantage of some of the big deals we're seeing in this market right now, because we never know if these deals are going to last into the next few weeks as we go into small cap earnings season. But anyways guys, make sure to drop me a thumbs up if you found some value from this video. Let me know down in the comment section below what you guys thought of Facebook and Snapchat's earnings. But anyways guys, I hope you enjoyed this video, and I'll catch you guys in the next one. Take care.